Hello and welcome to another episode of Fintech Focus TV with me, Toby. Today, I'm absolutely delighted to be joined from the US by Ray Kahn. Ray, how are you?
I'm great. Thank you for having me.
It's an absolute pleasure. Thanks for joining us. And we've been talking about this for a while. I know you've watched a few of the shows, so it's great to have you on. And it's great to have you on from a number of different aspects. We're going to be talking about so much of your background over the course of today. We're going to be talking about the stealth mode that you're emerging out of with your new business, but also some of the advisory stuff you've been doing in the overall climate of fintech at the moment. But Ray, a man who's had a stellar career so far, expanding in all sorts of areas. Tell us a little bit about yourself and what you've been up to.
So I spent most of my career, 25 plus years, at large financial institutions, from large banks and large exchanges. And I think it was really about 2014 that I realized the importance of technology and emerging technology to basically fix or help fix a lot of issues that the capital markets is having and experiencing. And the technology is really needed, and it's a broad array of technology. Some of it's DLT, some of it's database, some of it is things like Snowflake. But I started working in 2014 with a number of both external and internal entities at Barclays to start putting in place smart contracts or any type of technology that would make the business I was running, which was OTC derivatives clearing and futures business, more efficient, because there was hundreds of people involved at every major dealer doing post-trade reconciliation, post-trade payments, and it's not really sustainable in terms of getting a high enough return to support all those people. And then there was a number of new regulations that came in post the credit crisis. Some of them were customer protection rules, some of them were clearing rules, some of them were reporting rules, regulatory rules, and all the technologists at all the major firms were working on regulatory mandated projects. And so it looked to me that we needed to look to new technology to become more efficient. So really, since about 2014, I've spent time thinking about and working with both external providers and new technology providers and internal large financial institutions on implementing new sources of efficiencies. Those efficiencies can be in the terms of cost efficiencies, margin efficiencies, risk management efficiencies, headcount efficiencies. And really, the technology is the way that needs to get it done.
Absolutely, and we're seeing more and more of that sort of innovation come through as well. And efficiencies is absolutely the word, isn't it? If there's anything driving, capital markets at the moment, it's technology. I've seen things written yesterday that certainly aren't revolutionary, but it was pointing towards the fact of 20 years ago you saw technology as a cost center, and now it's absolutely driving profit for all of the major institutions. And we've seen that sort of develop, and we'll come on to that because I want to talk about your advisory work and everything you've seen from Lehman's in 2008 through to Barclays and everything that thereafter. And Barclays, I always think, have been very pioneering in that particular space. How you brought that out, but also in September 2019, you sort of been working on a little bit of a sort of stealth mode project that seems quite exciting as well. USREM. Tell us a little bit about that at the moment.
Right. So USREM was basically a combination of commercial real estate, capital markets, and technology. Yeah. The team was established in September of 2019. We started working together. It is founded by an individual named David S. Rose. David S. Rose is well known in the world of angel investing. He's written several books, one with the foreword from Reid Hoffman. He's also part of a multi-generational real estate family, so he's well connected. He assembled a very strong team of people in real estate, technology, and capital markets. My strength is on the capital market side and technology. And what we're doing, that we look to make investing in commercial real estate both easier, more economic, with less friction than exists right now. What people didn't realize, and I didn't realize till I started working on this project, global real estate is the largest asset class in the world by a very large magnitude. It is 3 times bigger than the global equity market and 2 times bigger than the global bond market. We all think the global bond market is huge, and it is. Real estate is much bigger. However, unless you're at some of the largest institutions in the world, in the form of resources, both capital and individuals, and expertise, it's difficult to invest in real estate without having a large amount of friction. So what we're trying to do is build a platform relying on both financial intermediaries that are trusted right now, and also new technology, digital technology. It's really a hybrid of both, and put that in place so that a larger amount of companies or a larger amount of institutions can invest, particularly in the low yield environment that we have globally, with yields somewhere around 0%, around 1% in the US. There is a huge demand for better yield, better cash flow, but with less volatility. And commercial real estate has in the past has shown to provide that. Obviously, we have a COVID-19 situation that has altered the world a bit, but we still do believe, and we do believe investors around the world will still need and want to use real estate as one of the foundational investment assets in which to get yield with less volatility.
So that's a really interesting piece that you mentioned there. So COVID, you're what, 6 months into this, and COVID really strikes. So 6 months later, you're coming out of that sort of stealth mode and really starting to move the company further forward. We've seen massive volatility in the markets based on what's happening on a social level and the impacts that's COVID's having. Real estate's been one of those areas that's been impacted both positively and negatively, depending on who you speak to, and whether you're in the suburbs or there's all sorts of questions being asked about the sort of viability of real estate in the capitals, London and New York in particular. What sort of impact has that had on the business?
I mean, we've pivoted a bit, but not necessarily a huge amount, because, and I'm not going to go totally into our strategy, but the fact is, when we were looking at the buildings of which we would transact, right, we were focused on core and core plus, which really means buildings that are fully leased up or close to fully leased up, are stable, that don't require huge amounts of investments. Yeah. A more volatile and a more impacted sector is the value add sector, where you buy a building, you make major changes to it, or you buy a property and you're building a hotel, or you're building retail to go along with that. So on the positive side, our focus was on the more stable side of real estate at the beginning, which was really focused on multi-family buildings, apartment buildings, offices, and industrial buildings and triple net lease buildings. So the factor is, I think we had, before COVID-19, we had a bit more focus on the office sector, but with basically more focus on the buildings that are doing better in the current situation. That does not mean we're still not focusing on office too. It's just there's more uncertainty really on the timing of how office buildings and what the office world exists, which is no different than any real estate expert that you may have on or that do speak and are trying to figure out what to do every day. They're much bigger experts than myself on that. But we're trying to basically create a platform that creates tremendous flexibility and versatility to invest in the type of buildings that investors wish to invest. And if right now they're more comfortable with multifamily, then that is what will be the focus of our platform. If in a year, 6 months, they're more comfortable or getting more comfortable again with offices, we'll provide that. Our platform is meant to be flexible and versatile and provide buildings for which the investors can invest, and then sellers that wish to sell their buildings are able to sell their properties. What's interesting is, I would say, for the first 3-4 months after COVID, real estate market completely dead. Brokers really weren't showing too much. But we are starting to see more properties come to market and more activity out of the world of real estate brokers. So, I can't say and I'm not an expert on this, but I can't say the transaction log is setting any records. But there does seem to be some sprouts in terms of, people starting to realize you have to go about, having places to live, owning places to live, having places to work. So It's been very interesting. It's not necessarily something that you would say, hey, let's have a pandemic in the middle of a startup, but we adjust, and I think we have a very mature, flexible team, and we're able to adjust.
And that sort of team is often the critical part of these sort of times, isn't it? and you've assembled, as you say, some of the best in all of those sort of areas with a company there that's looking at 3-4 different sort of backgrounds in technology and capital markets and real estate and that fusion of each. How's it gelling as a team over the course of the first year, and particularly with a team that I imagine hasn't had all that time sort of huddled together during that period?
Well, it's interesting. I think COVID-19 created, obviously, we learned how to use Zoom, and we do, some of the people with more tech backgrounds, which a subset of the team, they basically taught us how to do things like stand-ups. I'd never heard of a stand-up, right? So things like that. So we have stand-ups every day. And basically, we're trying to implement some of the more techie, if you will, type of procedures they do for us that were more capital markets people. So I think we've learned to work very well together. Our expertise differs, so we all have our lanes that we sort of focus on, and then we can get advice. So one of the things when you have an individual and a founder such as David S. Rose, right? He is connected across the entire VC, but he's also connected across the angel landscape. He actually started New York Angels, I think about 30 years ago. I believe New York Angels might be the biggest angel network in the country. He also was the founder of Gust. Gust is a platform that almost every major startup or angel investment platform around the globe, including most universities and in a number of countries, they use Gust for the startup. To basically use that, you can be a startup and get a lot of services to make it more efficient to run your startup. But it also allows investors to look to see those opportunities. On Gust, there are hundreds of thousands of different companies have gone through the Gust platform. And because of that, David and his expertise and his relationship tree is tremendous. So it allows us to meet people, to get recommendations from people, and all these areas and benefits of having a mature team. And the team is made up of former CTO of Barclays, Samir Jain, very knowledgeable, very connected. I don't want to go into the whole team, but all of them, every one of us that is in the room has very strong credentials.
And what sort of allowed you to assemble? What was the sort of collective part behind that? I mean, was it the founding team? Is that same founding team, or has it just been a sort of magnet from David S. Rose himself, or was it just the sort of right time for a number of you to come together?
I think the credit needs to go for assembling a team to David. David did that. David has had the vision, and David explained the vision to us, and we look at it and we saw it, and we all said, this is a tremendous vision. And while, the platforms are difficult to build. There's platforms all over the place. There's corporate bond platforms, which I've been involved in. There's market platforms. And this is a platform different than a lot of the capital markets platforms. There's really not a standard real estate platform out there. So this is different. So it required a fairly experienced team to try to navigate it. And we are doing that. And there's a regulatory component, there's a market component, there's an investing in the building component, there's a seller component, there's real estate brokers component, there's many components. And David was able to put on paper what his vision is, and in a way that convinced a strong team to join. And it's much different than what I've done working for large financial institutions in the past. It's much different every day, but it's very exciting.
And that's always a great thing to hear, isn't it? When you're moving into an exciting business, and one that has pivoted as well, which I think is interesting. When you're looking at businesses there that have had this sort of thing, some people have stuck to their guns and said, look, this is how we're going to be, and others have looked at it and said, right, how can we make this work for us? I guess that's the benefit of that team, isn't it? To have gone through, the various things that all of you have been through the last 20, 25 years or so. Tell us how that's worked for you, because it's not only with just this project you're on, you also, I know do a lot of advisory. How does your experience help you to sort of maximize that advisory thing? And what sort of advice are you putting out there into the marketplace at the moment?
So in 2014, I met Arjun from Baton. He came in to meet with me at Barclays. And then we started working together. He was working on a payment system, which I think he's been on the network. And I think he's been in, and I started working with him and advising him, looking for ways to improve the payment process that goes through an FCM in a futures business, the business that I ran. And the interesting thing is there, and that sort of really started my interest. I started with CME, Bank of New York and Barclays, a proof of concept, and brought in Baton, right? And because I was very impressed with their payment system and their on-demand real-time payment. And so one of the things I would constantly tell Arjun and the team is you have to find your niche, right? You have to find a problem that you can solve for the bigger financial institution. You can't come in with this huge, like, we're going to create a payment system and it's going to replace the 130 different payment systems that are running at a JP Morgan. Find a niche, basically convince someone that you can help CME or that you can help Barclays, you can help Bank of New York. And I think as a good example, Baton has done a fantastic job of that. And Arjun and his team can speak for themselves, but they have created a niche and they have basically gone into major financial institutions, including exchanges and banks, and they are running their technology, and their technology is expanding because they found the right place to basically deploy it. And they worked very hard and they worked for multiple years. Another company that I'm excited about that I work with is Inca Digital Securities, an individual named Adam Zarinsky. He's actually a very interesting background. He's a former JAG and he has a former Interpol Intel background. Basically, they are using their digital analytics, a lot of work for the governments. I know they're working with the US government. I don't know what other governments they're working on, basically a combination of financial analytics and regulatory analytics. And it's state of the art, it's cutting edge. As I said, he has military background, intelligence background. It's really cool. It's kind of James Bond-like, but he has also found his niche. Another company I'm working with is called Zero Beta, a group of very strong technologists, and they're building a multi-purpose risk management tool, which is different than other stuff that exists. I think the key is, companies I advise in capital markets, is find a way to create efficiencies. If you can create efficiencies and you can show that to the larger providers, they will have reason to focus on you. The other thing is now it pretty much needs to be in the cloud. I hadn't heard of the cloud when I started this in 2014, but now it needs to be simple to implement. None of the larger institutions have excess technologists or excess money for discretionary projects. So the more you can get done and then build that in and deliver it, it makes it a much better chance of being selected and being used. And so now you see a lot of these sort of connective companies, if you will. The one that I can speak of, which I know the individuals, but I don't advise to, is OpenFin, right? OpenFin is Nazidar has been a tremendous success, right? And that platform is being used by thousands of entities, the largest financial institutions, the largest, buy-side investors, hedge funds and stuff. But I'm not an expert on the technology, but it's creating connectivity that allows simplicity for people to stream their markets to. So whatever product the companies I advise are providing, whatever technology, figure out a way to connect easily to your potential clients, and that will increase the opportunity for your product, your technology to be used.
So that's an interesting part, isn't it? Because I think what you've just described is the absolute, it's the hook for any business that sort of works well within the space. But it isn't an easy thing to do, and connecting easily is the part that people struggle with, particularly because of procurement. And you're from a large institutional background where you do have incredibly difficult procurement processes to navigate. And that is quite often the stranglehold that stops so many innovators being able to sort of take a good product through to a proof of concept, through to something that gets embedded into a business and have the financial lifeline to do that. What sort of advice are you giving to companies who are struggling with that procurement process and running out of runway, particularly with a more difficult landscape for investment at the moment?
Well, handling the burn is far more difficult because of COVID. So you have to learn to do that. But at the same time, you have to be able to differentiate why your product is so useful to the end user. And what I've seen, both companies that are succeeding and companies that have not succeeded, if they cannot differentiate why the product is needed or why the technology is needed, it's very difficult. You don't get that many chances at the large institutions, right? So it's got to be strong. The other thing I would say is sometimes, and this is hard for clients and people with technology on their mind, sometimes you don't start with the largest financial institutions. The largest financial institutions are very difficult nut to crack, right? They have their own internal teams. There's a lot of layers. There's a lot of challenges that they have to deal with internally every day. So you're smaller and coming in. In certain instances, start with the next layer, tier 2, tier 3, smaller ones that probably do not have as large of tech stack, don't have as large of technology resources. But those are often the institutions that are more willing and you can provide a service or a technology that is beneficial to them, because maybe they don't have, a team of 20 technologists to build the risk management tool. Maybe they don't have, maybe they're dealing in the crypto space. If you go to the heavy, computer-based traders, they have great technologists, they have great resources, they have great technology. They probably will not need your technology. However, some institutions or less than institutions that wish to trade crypto or trading crypto may be willing to use your surveillance tool or your risk management tools because they don't have the resources to do that. The people that they have working for them are trading every day, trying to make money every day, and then any development is going on probably at night, right, by them or some people they've hired. So sometimes it makes sense to basically focus on the mid-tier size or even the smaller tier size just to get your product going and to basically have it implemented and in production.
So this is about sort of effectively driving up the field rather than trying to throw the Hail Mary as your first pass to score the touchdown. Right, we're progressively looking at smaller wins to create the big the big win at the end of it.
Yeah, you have to have the smaller wins because the smaller wins proves the validity of your technology. And there's just like the Hail Mary, I don't know what percentage of them work. It's, let's say 12% or something like that, right? But you need to basically show something. And if you can show something and have it in production at some place, it shows that it is working and it is providing the efficiencies that you say it is, or it's providing the opportunity to generate more revenue, right? The whole goal of all these technologies that most of the companies that I work is trying to basically improve the operating income, really, of the firm. And that can be done in two ways. You can generate more revenue, which is usually at the big firms I've worked at, it's always been a focus on generating more revenue, particularly before the credit crisis in 08-09. After 08-09 and the regulatory rules changed, it became, how do you increase your return on capital? Because all the rules changed and things like that. Whether you're using return on capital, generating more money, savings has the same impact of generating revenue. If you can save money, it doesn't get the same glory, right? And there's more focus on revenue generation. But if you can save $50 million, right, of cost, or save $50 million of capital, right, that's the same as generating an extra $50 million of capital. It's not nearly as glamorous. The post-trade area is not as glamorous, but that's where a lot of the opportunities are in post-trade. The amount of money and resources being spent on the pre-trade and the execution in the capital markets is massive. Where the most need is, the biggest challenges are in the post-trade and operations, settlement, and payment world. It's not glamorous, right? But that's where the opportunities are. That's where companies like Baton are thriving.
So I've been hearing a lot about post-trade for the best part of a year now. Why is it post-trade's golden age at the moment?
The issue with post-trade is like the major institutions, and almost all the trades do flow through the major institutions. So in my old world, futures, there's really only 10 relevant clearers. They can clear major amounts of volume for clients, right? And so because of that, and futures volumes have increased immensely over the past decade, partially because there's there's better systems, there's better trading, there's better computers, but also the product has grown. There's been regulatory rules that help drive more business into the exchanges. But to support the exchanges are the dealer community. So the major 10 dealers, 12 dealers are supporting most of the futures volume. Well, the systems they're using, and this is nothing against them, are old, right? They're old systems that were built, 10 years ago or more, right? But it's very difficult to bring them down and pull them offline to put something new in place. And so a lot of the times I've seen institutions and technology firms that just said, move it to cloud and make it digital. Well, that's a grand statement. You're gonna have to basically move it over time, right? You're gonna have to basically take out not nodes of it and roll that out, because there's a regulatory component and there's thousands of clients that are connected to it across the globe, and you can't just change it because then you won't have the connectivity. So to alter the connectivity that you have in the financial markets is going to take hundreds and hundreds of small moves and not one big bang. Now that's not anyone doing it wrong. That's just reality of the situation. If you're large institutions, you've connected and you have straight line processing and all this type of stuff, but it's done a certain way, and to change it is going to take time. And so institutions are working on it and working on it slowly, bit by bit. But the thing is, no one institution or no one, technology provider is going to basically make a major shift to the systems that are being used globally. It's a connective spider web, and it needs to be addressed, but it needs to be addressed over time. And JP handles it different than Barclays, who handles it different than Goldman. They use some similar systems, but they've also built their own systems. And so for any technology provider to just walk in with a just-in-time system is difficult to do.
It's an interesting one as well, isn't it? Because I think the sort of years of, we've seen this sort of self-build programs and lots of the institutions building themselves. We've seen enterprise systems that are there, and there's big legacy issues with with some of those systems in there that haven't evolved necessarily, but are very difficult to get away from. But we're also seeing this sort of niche thing, as you mentioned before, where lots of people are solving a sort of myriad of different problems across the sort of trading landscape, particularly in capital markets, where we're seeing a ever increasing number of vendors in individual institutions. Do you see that as the future? I mean, is it the end of the enterprise? Are we seeing a sort of much more, I guess, open market within that? We're going to see a lot more different, a lot of different businesses entering the play. What's your take on that?
Yeah, my take is that the big banks and the big traders, is not just the banks, it's the BlackRocks and everyone, the big market makers and all the big, programmatic trading. They have the technology and they have the resources to build themselves. That being said, now as returns are challenged and costs are high, the decision is more, do we build it ourselves? Yes, we could build it ourselves, but I would say in the last 5 years, you're seeing the major financial institutions starting to say, no, we're gonna build the stuff that we want to build ourselves, but some of the stuff that's commodity-like, or we can't differentiate our offering from our competitors, then we're going to basically look at ways to purchase that, right? So I think a very good example of this is Broadridge. So Broadridge they're a post-trade service. I believe they started as an outsourced company, India outsourcing company, but now they are the largest provider of post-trade clearing services for Treasury securities. So for Treasury securities, there's 23 or 24 primary U.S. Treasury dealers. In the past, they used to all do their all clearing. They had their post-trade people. They had their ops team that do it all. The last time I heard, and I'm not sure if I'm current, Broadridge is now providing the post-trade clearing services for, I believe, at least 18 of the major dealers, including the likes of JP Morgan and Bank of America, right? 10 years ago, there's no way that any of those entities would have outsourced their post-trade activity to someone outside of the bank. They would have built it. They would have continued to improve it every day, every year. They would basically make the changes annually that they needed to do for regulatory purposes. Now, a Broadridge came in, deploying both people and technology to basically create that. And Broadridge created their niche for that. And I was stunned when I found out that Broadridge had 75% of the major market players in the largest market for something that has to be done very well and has to be done every day, but no one can differentiate their offering. So this is an example of the big banks saying, if someone else can do this complex but necessary function cheaper, we can deploy our best technologists to do things that we believe differentiates our offering, and not basically have our technologists building the same platform at JP that is being built at B of A, which in a centralized utility-like function is better.
That exists as well elsewhere, isn't it? It's fascinating, and this is Ray. This is something which I feel like I could be talking to you for days about. To be perfectly honest, I think it's a really interesting.
I would just
area.
add one thing. We at Barclays, when I was running U.S. futures and OTC clearing, we tried to do the same thing with SunGard, now FIS. We basically took part of our operational team and put it into FIS, right? And then the plan was to create, FIS was going to create a utility to basically do the clearing post-trade processes in the future space. Now, I believe that FIS, since I left the future space, has added CS and a few other dealers, but so far that has not taken off in the future space as it has in the treasury space. I'm not sure why, but if people can figure that out and figure out a component, you may not be, FIS is a very large organization, right? SunGard and FIS, but if you can provide your niches to provide that type of stuff, you can basically continue to expand upon that.
Yeah, I think that's it comes back down to exactly what you said at the start, that if go niche, find efficiencies, and make things simple. It's been we every year, as you may know, with the Financial Technologist magazine, we're looking at what makes the most impressive companies of the year ahead, that we do this listing every single year in the magazine. And overwhelmingly, every single time I speak to the founders of these companies who are listed in it, you are talking about visionary people there who are absolutely answering that question and looking to provide the efficiencies for where people are. And they're not trying to be everything to everyone. They're very specific in what they're trying to solve. They know who they are, and they're not trying to be everything to everyone. And I think that's exceptional advice that comes into it. And Ray, I'd love to sort of follow that up with another show with you on it, because I think there's a whole load more I'd love to dive into. But I want to finish with USREM and everything you're doing there as well at the moment. So you're a year in. What does the next year look like? With everything you've navigated, are you able to sort of suggest that? Do you know where you're heading, or is it going to be more pivoting and rolling with the economy?
Based on what I know and what we can project about the economy and the world, I think our major pivot has been done. I think we've made tremendous strides from last September to now. Our product is simpler, easier to understand, makes more sense, right? When we first started, it was extremely grand, extremely large, had too many moving parts. And I think whether it be COVID or the time spent has allowed us to make it simpler, make it easier for investors in our company and investors in the product that we will be launching. It's easier for them to understand. And that's one of the things that I have learned is when you go out to talk about your technology, your platform, make it so it's simple, right? Because if it's confusing, even though you don't think it's confusing, but if the people you're trying to attract feel it's confusing, then the chances of it succeeding is not great. And I think while we spent 12 hours, 14 hours a day in a room thinking this made total sense, at one point, and when we started, we all had grand visions, and it was too complex. And our investors, or our potential investors, told us that, right?
Yeah.
And they basically, you have to listen to the audience that you're going to. They're very smart. We've had the we'd have the opportunity to speak to a lot of very successful, very smart individuals across VC, across private equity, across angel investing. And it's unbelievable how many smart people are out there, right? It's stunning, right? And I've not been exposed to this side of the world. So I'm learning every day, but simplicity is very important. And, I'm proud of what we have accomplished in the first year. And one of the things I'm proud of is part of our pivot was a simplification, right? So maybe the word isn't pivot, maybe it's simplification. And that's not to say that we've stripped it down to just the bare bones because that's what we thought was necessary. I just think when we all got in the room, we didn't understand the complexity of what we were building necessarily before we started. And then we did, and we realized, you need to make this simple to start, and then you will grow it and you will expand it, which is the same as what I've told the clients I consult, but maybe I wasn't consulting myself at the beginning, right? So
cobbler's shoes, classic case of.
Yes.
Absolutely. Well, it sounds fascinating. And who should be speaking to you? Who should be reaching out to find out more about the business, and who can you help?
We can help investors that are looking to buy real estate. We believe, and more to come on that the framework we've set up is far more flexible way to buy real estate, creating a better way to basically buy and sell institutional real estate. So investors should speak to us. As with any startup, you're always doing funding, right? We've completed a funding round, but there'll most likely be needs for more funding. We are working on finalizing our first building in the upcoming months. And once we get this going and can show people what we're doing, I think it's very exciting. And I think it will be of interest to a lot of investors globally. Because I think we've deployed or are deploying very smart rationale and thinking about how to address the world of real estate in a way that has looked at both real estate and capital markets. It's interesting. They're two distinct markets, and they're both heavily regulated markets. The real estate market is heavily regulated, and real estate gets sold by real estate brokers, right? And the only interaction between the two markets is CMBS, which is on the liability side of the trade. And that's a huge market, that's massive. The asset side of the market isn't really touched in commercial real estate. Then you have the capital market side. The capital market side, obviously global, diverse, very efficient, all these types of stuff. There has not really been a good bridge between the real estate market regulated by real estate brokers and the capital markets by regulated securities brokers. There has not been really a bridge across that divide. And we believe that we're helping to make that better in a way that we believe will start small, but then expand.
So exciting times, and people should definitely get in touch with that as well, Ray. Ray, will you come back onto the show? And there's loads I want to talk about the ecosystem. I know you've got sort of big thoughts about what's happening in the fintech space as well, and I feel like we could be talking for a whole load more about that. And I'd love to do another show and discuss actually that whole ecosystem and the opportunities in it as well. Would you do that with us?
I would be delighted to come back anytime. I've looked at the people you have on, and impressive lot, and I'm very, very honored to have gotten the opportunity to speak to you today. So I'm happy to come on anytime.
Well, that's wonderful to hear. Ray, thank you so much for your time. It's been utter pleasure, a privilege, and education, and I've really enjoyed it. So thank you so much for joining us.
Thank you, Toby, and good luck in handling the world situation.
We're doing our very best. Listen, thank you for coming on, and thank you all for watching. We'll see you soon on another episode of Fintech Focus TV. Thanks a lot.